Hi, everyone, and thank you for joining us. I'm excited to welcome Stephen Hochberg, the Chief Market Analyst for Elliott Wave International and a close associate of Robert Prechter. He is recognized as one of the world's foremost experts on the wave principle and its application to market forecasting. Mr. Hochberg, thanks for being here. The floor is yours.
Thanks very much. I appreciate it. Really excited to be with everyone this morning. I think this is the perfect time to actually talk about markets and what's happening because I think the next several months are going to be pretty fascinating. So I've got a lot to cover. I'm going to mainly focus on the stock market because that's really what's going to be in investors' forefront over the coming months. I'm going to touch on bonds very briefly and also real estate because that's been in the headlines. So let's get right at it. Crisis and opportunity, an Elliott Wave overview of the markets. So I think what a good place to start is actually about 18 months ago, because I think that's a good leading edge to bring us to where we are. And if you go back about 18 months ago to the start of 2021, the end of 2020, a lot of interesting things were happening. Number one, we're just getting through that initial phase of COVID. We had that market meltdown into March of 2020, and the market came roaring back after that toward the end of the year into 2021. One of the world's most popular news aggregators published this headline saying that tech could bring new roaring 20s. And he was referring to, or this site was referring to, the 1920s when we had this huge bull market from September 1921 to September 1929. And of course, we know what happened after September 1929, but that was up about 500% over this period and really was a great time in the market and a great time for the country. And the idea was that we were moving into this kind of replay of the roaring 20s, but this time it was going to be 2020, 2021, 2022, and so forth going forward. And of course, as you've been following us at Elliott Wave International, you know we were pushing back against that pretty heavily. And there was a number of reasons. One was because the model that we use, the Elliott Wave model, which I'll get into in a minute, was saying, no, we're at the end of the move, not at the beginning. And then there were some other indicators. And I want to get into those indicators because this is one or a table that we showed in our newsletter, the Elliott Wave Financial Forecast, as we went into January 2021. And it's a table and chart from Crescott Capital. And basically, it's a valuation measure. They took 15 of various valuation metrics and they put it all together and combined it in a chart. Now, 11 of the 15 metrics, which you see on the right side of your screen, were at all-time historical highs, and the other 4 were close to all-time highs. And so when you look at how the valuation shifted over time, this is from the 1900s to the present, you can see that when times were very overvalued in terms of these metrics, the market was at a high or very close to it. For example, right here, prior to the Great Depression, the crash of 1929. This was the early 60s, the go-go peak years. Of course, we had the dot-com mania that peaked in 2000. Valuations were historically high. And then here we are now, or as we're entering 2021, with valuations off the chart. In fact, this was the highest level in the history. Now, when you go back to the 1920s and the roaring 20s, what you had was exactly the opposite. Starting the 1920s, you had the lowest valuation in 120 years of this data. And that's what led to the roaring 20s. So here we are, exactly the opposite in terms of valuation, historically overvalued to a degree that we've never been in the history of our country. So that was one of the things that was leading us to push back on this narrative that was being pushed in the media that we were coming into the roaring 20s. Now, I want to give you a quick down and dirty on Elliott Wave. I don't need to get into a lot of the detail here, but this is the model we use. This is a simple schematic of an Elliott Wave. And basically, it shows that the market is patterned and it subdivides into 5 waves in the direction of the trend and 3 waves against it. And the important part is that once this 5-wave move is complete, you always go into this correction, this 3-wave correction. One other key point is that an Elliott wave model is a fractal, and a fractal means that there's self-similar patterns at all degrees of scale. So while you see a 5-wave move in this red squiggle I just showed, if you look within that, you also see that each of these waves break down into 5 waves. And even when you look at each of these subwaves, they break down into 5 waves. So they're self-similar patterns at all degrees of scale, from 1-minute chart up to yearly charts, even higher. So with this model in mind, let's take a look and see how we apply it to the US stock market. This is the Dow Jones Industrial Average, starting at the 1929 high, which is in your lower left corner. This was the crash into the 1932 low, and this is the market since then. And we've applied Elliott Wave labels to each of these moves. So you can see that there's a 5-wave pattern at this degree, all the way from the 1932 low up to this high. And when you look inside each of these waves, each of them also subdivides into 5 waves in the direction of the 1 larger degree trend. So this is the kind of model that we were looking at. We were looking at the market rallying, and we were noticing these 5-wave patterns. And now what I want to do is kind of hone in on each of these little 5 waves to see if we can get some information about the future. So what we're going to look at now is just the 5th wave from the 1974 low. And you can see it subdivides into 5 waves. Wave 3 peaked out in the March 2000 dot-com mania peak, led to an ABC correction. That was the end of a 4th wave. And now we've got this 5th wave to the upside from the 2009 low, the end of the Great Credit Crisis. So let's focus in on this 5-wave rally from there. So this is March of 2009, the end of the Great Credit Crisis. And we were tracking this 5-wave rally that was carrying up to this top of this trend line. Now we published this chart. This chart is data as of March of 2021. And that's an important time because really January, February, March of 2021, about 18, 19 months ago, was the leading edge of the peak in the stock market. Now, the major averages held up till later in that year. For example, the NASDAQ peaked in November of 2021, and the Dow and S&P peaked in January of 2022. But there were a lot of high-profile, high-name speculative stocks that peaked out in this period, which was giving us a clue that the market in general was turning. And here are some of the stocks. We ran this collage in the January issue this year of the Elliott Wave Financial Forecast, which is the letter that I publish with my partner, Peter Kendall. Comes out every month, and we forecast the trends in a whole host of areas, including the market. But you notice that ARK Innovations right here, this is Cathie Wood's fund, that peaked in January, February of 2021. The meme stocks led by GameStop peaked out in January, February 2021. The SPAC index, the special purpose acquisition stocks, peaked out in that same time period. And a lot of these high profile stocks not only peaked then, but had these huge declines throughout 2021, which was interesting because people were still super bullish throughout the year, even though a lot of these speculative, the focus of a lot of people's or investors' speculative intensity had peaked out and was down huge amounts. I mean, look at the decline in Peloton, which was a favorite of the retail crowd. So this was an idea that something was going on, and we thought that something was the transition from that big bull market that we had into the beginnings of a big bear market. Not only were these stocks peaking out and going down, but what was so interesting is that investors were using a lot of margin to buy these stocks. Now, this is the New York Stock Exchange margin debt, and margin debt was screaming. Peaked at well over $800 billion of people, investors, using margin to buy equities. So not only were the speculative focus of the market, not only was that peaking out and going down, but it didn't matter. People were still using margin to buy stocks. And if you notice that each time that you went to a new all-time high in margin debt that exceeded the previous high by a pretty significant amount, they usually coincide with peaks in the stock market. Sometimes they're coincidence, sometimes it comes a little bit before, sometimes it comes a little bit after. So we were seeing this huge surge in margin debt, which is another signal to us that we were at the end of this big bull market. Valuations, we talked about that briefly to start with from that initial chart of Crescat Capital. But one of the things that we were looking at, and we have published in our newsletter, was the S&P price to sales ratio, because it was screaming. Now, we happen to like this better than price to earnings. We don't use valuation as a forecasting tool. We use the model, the Elliott Wave model, to do that. But we do look at valuations to kind of get a landscape, a backdrop of what's happening. And as you can see, price to sales were skyrocketing. At this point, when we published the chart, they were 25, the market was, in terms of sales, 25% more overvalued than the top day of the dot-com mania in March of 2000. Well, what happened was that with price to sales is that since we published it, it actually rose to a peak of 3.18 on December 29th of last year, 2021, about 9-10 months ago. It has now since come down to about 2.35. So we are at a level today that is equal to the top day of when we peaked at the end of the dot-com mania in March of 2000. And of course, you know that the S&P 500 declined 50%, lost half its value into 2002. We had that rebound into 2007. And then, of course, the big decline into 2009. So we're here right about now on price to sales. We think by the end of this bear market, we're going to be down here eclipsing the low of 2009. So I'm going to come back to this simple schematic again, just to kind of give you an idea of, in your mind, keep this picture in your mind, because it's an important picture and it's what we use as a lens to judge where we're going in stocks. Here's the Dow Jones Industrial Average from that March 2009 low. This chart is updated. We published this in our most recent issue of the newsletter, Elliott Wave Financial Forecast. Excuse me, and it shows a 5-wave rally. That rally peaked in January of this year. We came above the top trend line of this channel, this Elliott Wave channel. We danced upon it for several months and came back down below it, made an interim low in mid-June, and then rallied into mid-August. So that's kind of where we are today. We're turning around, completed this 5 up, and we think the next move is going to be a 5-wave decline to the downside as part of this bear market. Now, these two charts were shown in the Elliott Wave Theorist, which Bob Prechter writes. That's his newsletter that he's been publishing since the late 1970s. And he showed two potentials for what kind of the model is that we're going to be looking at. The one on the left is just a simple schematic. That 5-wave pattern I showed you to the upside, we just flipped it over and we're now showing it going to the downside. And at the time Bob published this, we were right here in the middle of this second wave rally. This is a bear market model. We're using one of the kind of paths that the market might take on the way down. And this on the right is simply the Dow Jones Industrial from the March 1937 high to the March 1938 low. This was a 1-year decline. The Dow lost 50% of its value. And it gives us a good kind of roadmap on what the decline might look like. There's variations it could take, but this is kind of how we're looking at the potential of what's happening. Now, when we first published this, we were in the middle of the rally. That rally peaked on August 16th. We think right now, in terms of you are here, we're right about there. Turn the corner. So we're right about here in this model from 1937. And what lies ahead is probably one of the steepest portions of the bear market that we're going to see. In the Elliott Wave Financial Forecast with Pete and I, we published this 2 months ago in our August issue. And what we did was we looked at past major bear markets since the crash of 1929 to see if there's any similarities or anything we can glean from them that might help us in forecasting the future. And one of the things that we noticed, and the top is the Dow in 1937, we just saw that chart. Second chart is the Dow and the bear market from 73 to 74. This is the S&P from the dot-com mania in 2000 to 2002. And this is the Dow and the great credit crisis of 2007, 2009. And the bottom is where we are today. One of the things that we noticed that we thought was interesting is that several months after you made your final high, that big snapback rally, that bear market rally, got you pretty close to your previous peak. For example, 1937, we were 3% from the high 5 months later. In 1974, we peaked in January of 73. 9 months, fully 9 months later, we were within 6% of the previous high. And after the dot-com mania in 2000, notice that the S&P was in just 2% from its previous peak a full 6 months later. And of course, it went on to decline 50% thereafter. And then 2009, we were 7.5% from the previous peak 7 months after the high. Well, in the snapback rally that we had this time, the Dow got about 7.5%, 7.2% from its previous peak this January, almost like we did in 2009. The S&P got within 10% before it rolled over. So in terms of the models and how they're shaping up, we're exactly where we should be in our estimation in terms of the progression of this bear market. This is the S&P 500. We just published this last Friday in a brand new issue of our newsletter, and it shows the 5-wave rally into the peak in January from that kind of COVID low, we call it, in March of 2020. We had a 5-wave decline for wave 1 into June. This is a special pattern that we call a leading diagonal, which is a wedge shape that came into a low in mid-June. We had an ABC rally that topped exactly where it should have topped in terms of how we look at this. And now we've turned the corner to start the next wave down of this bear market. And one of the things that really interested us and kind of gave us a lot of confidence that this indeed was a bear market rally that was ending was just how excited people got within the rally. We saw sentiment really explode into a lot of bullishness. And some of the headlines that we saw and that we published in our newsletter says this: S&P 500 triggers a signal with a perfect track record for calling the end of bear markets. NASDAQ.com had one. These two perfect indicators say the bear market is over. I've been in this business a while and I know a lot of indicators, and I've never known an indicator to be perfect. And just because we're dealing with human beings and human nature. But in any event, that shows a lot of excitement to the market in our estimation. Here's two more headlines. Famous analyst says S&P 500 has already bottomed and that he sees no hard landing. And then Yahoo Finance, stock market could surge 18% to new highs by year end as the 2022 bear market is over. So these came basically 1 or 2 weeks after the July 16th and 7th or June 16th and 17th lows. They came a month after that. So what you're seeing is that the media and investors were very quick to embrace that rally as the start of a new bull market. And even retail investors were piling into stocks. This is shows the flows in and out of a basket of tech stocks tracked by Vanda Research. And you could see that with this latest move up in the market from mid-June to mid-August, retail investors surged back in. In fact, this was the highest amount that they put into a basket of tech stocks, these tech stocks down here, over this entire period. So people get really excited really quickly, which is a signal in terms of what we look at with the wave principle, that it was a counter trend rally and not the start of a new move to the upside, because usually there's a lot of pessimism and a lot of disbelief in the market, but that was kind of went away very quickly. And there's a lot of complacency too. This is simply the Cboe Volatility Index, the VIX, which we've inverted to more align with stock prices. And these arrows show how a low VIX, which means a rising line here, lined up very well with the previous market highs. For example, this is when the broad market top, the NASDAQ, the value line composite, and so forth. This is January when the Dow and the S&P top. This was the first counter trend rally top. And most recently in mid-August, the VIX came all the way back, and this is the recent high that we had. And we think that the VIX is in the process of going up, just like it has after each of these prior instances. So we think the next move in the VIX is going to be to the upside as the market goes down. And there's plenty of reason to look at the huge potential to the downside because, I mean, when you look at investors, they're still heavily invested in the market. They haven't capitulated. They haven't given up. They haven't said, I don't want stocks. And usually by the end of a bear market, that's when you'll see that. For example, this is the US household equity holdings as a percentage of total assets. Excuse me, it's still at 27.5%. That's higher than each of the peaks. This was the big peak of the go-go years in the bear market in the 70s. This is the peak of the dot-com mania. This was the crash of the great credit crisis. So by the time the bear market's over, we think this percentage right here is going to be down at a new all-time record. People aren't going to want to own stocks, and that's just typical of a bear market. So that brings us back to this kind of model that we've been looking at. So here's the model. Here's what it might look like on the way down. When might the stock market make an interim low or an important low? And what form might that take? So let's look at a couple cycles that we follow. And this is from Bob Prechter's new ebook, Forecast for the Bear 2022, 2024 and beyond. And we follow a number of different cycles, which kind of give us an idea of the pressure that's going to be on the market moving forward. For example, this is a 20-year and a 40-year cycle that we've been following for a number of years. So the market's made a low every 20 years, and then every 40 years, you've had a more serious decline. For example, 1942, which is the low of the inflation-adjusted Dow, that's the Dow PPI. This is when we had the lowest PE ratio of this entire century. The last big 40-year low is 1982, and in inflation-adjusted terms, the market just got crushed all the way down from 1966 to 82. Then we had the big bull market of the 1980s, and now we're on the hardest down portion of both these cycles, which are ideally scheduled to bottom in late this year, 2022. Another cycle that the Elliott Wave theorist Bob introduced in about 2010 is the 7-year cycle. And he used it at the time to project the next market low, which was going to be in 2016, which was a direct hit in terms of this cycle. The decline was particularly hard. Can't really see it here, but in the NASDAQ composite, it fell pretty sharply. Well, the next cycle low of this 7-year cycle is due next year in 2023. And of course, we have that famous 4-year cycle, which has been operating since 1934. It took over when the 3-year cycle stopped working in 1932 because of that deep low. So it's been a pretty regular cycle. This is from the 1930s all the way to the 1970s. And this cycle, excuse me, the 4-year cycle is brought forward to the present time. Now there was 2 shortened cycles here in the middle in the 2007-9 period up into 2011-12, but it's been pretty regular since then. And its next scheduled bottom is 2024 plus or minus 1 year, right? So time cycles are suggesting a pretty hard down market over the coming months to 2 years. Now, what form might that take? So we looked at timing Well, this is one of the forms that we're looking at for the bear market. In Elliott Wave parlance, this is a grand supercycle wave 4 bear market right here. And it matches up to the grand supercycle wave 2 bear market, which was from 1720 to 1784. It was a period of 64 years. Now, there's many forms it could take. This drawing right here shows it as a triangle lasting a long time. But notice that the first leg of the bear market is when you get your price low, your maximum price low. So in a triangle, you're going to get a very sharp down move initially. That will bottom, and then you'll have this big rally back. People will actually term that a bull market. It will feel like a bull market because prices will be rallying very strongly, but it's just part of this pattern that we're following that's going to take us sideways for at least 64 years, if not longer, as this triangle moves out to the right side of your screen. By the time it's over, most of us will be long gone, but there'll be huge periods and huge years of not only decline but rally too. So there'll be a lot of opportunity going forward. Another pattern it might take is a flat instead of a triangle, which is a little bit shorter pattern where we have initial down leg, we have a rally back that meets the prior peak, and then we come all the way down to end the bear market. But since this is a grand supercycle wave 4 and its cousin is here, we thought we'd take a look at this move right here, or at least the initial legs of this move, because it's important and it kind of gives us an idea of what we might expect. So that bear market was the one from 1720. It actually was a 64-year bear market, but the first leg of it, the first ABC decline, was only 2 years. And the market lost 90% of the value. If you remember, this is the South Sea Company when we had that mania back then. And what we notice here is that the sharpest portion of the initial leg of the bear market really lasted like a year or even less as the market came down really sharply. We bounced back, and then we had a lesser slope into the end of that ABC correction. So that's kind of a model that we have in mind. I think with cycles down so hard into the end of this year, next year, and 2024, I think the most lethal part of this bear market is going to be over this time period. Let's say the next year to year and a half, where stocks are really going to get hit hard. And it's this A wave that we're in right now. And it's this A wave we've got to be worried about because stocks are overvalued, overowned. And I think as the bear market progresses into this first move to the downside, people who own stocks are at high risk. Now, this A wave is likely to bottom in this first time period. Let's say maybe 2023, 2024, depends on where the 40-year and 20-year cycles actually lined up relative to the 7-year and the 4-year cycle. But suffice it to say that stocks are in a hard down move coming up. So that's our forecast for the stock market. I want to quickly turn, to the bond market, because bonds have had a cycle themselves. They don't always subdivide well into Elliott waves, but we can use other avenues to forecast bonds. We had a 39-year period of rising rates up into 1981. A 39-year period of declining rates. We had a record low close of 0.51%. That was August 4th of 2020. And over this period, this entire period down with falling rates, investors just gorged themselves on debt, over $7 trillion in the US aggregate corporate market value of outstanding debt. And it wasn't just treasury notes that went to a low. Corporate bonds went to a low, and even junk bonds hit multi-year lows. And all this was occurring with a huge amount of complacency. This is the MOVE index, which is the bond market equivalent to the VIX. and it was at record lows also. So people weren't expecting bond prices or bond yields to move up and prices to move down. And that's exactly what the cycles were telling us. This 39-year cycle that bottomed, this move up here, right here, doesn't look like much, but 10-year yield is currently around 3.28%. When we plot that, not on an arithmetic scale, but on log scale, you can, on a percentage basis, you can see what a huge rise it was. We've gone from 0.5% to 3.28% in the 10-year treasury. That's a 561% rise in rates. And it's not only the 10-year, but also a shorter term rate, like the 2-year, which before I came on, I just checked the price, or the yield rather, it's at 3.49%. So it was at 2.6% in April. It's up even higher. It's a 36 multiple in 19 months. It's a huge rise. And in fact, the 2-year at 3.49 yields more than the 10-year at 3.28. And that's what we call an inverted yield curve. And that really led to just a rout at the start of this year in terms of the bond market. Global bonds suffered massively, biggest global drawdown in their history. A lot of people lost a lot of money in the bond market to start the year. And it has significance because rising rates historically have led to different purges. And this is, you can see every time we've had rising rates, we've had these meltdowns in the market. And I think we're going to have the same now. Historic bear markets underway. Central bank will be vilified. A lot of financial failures, a lot of debt implosion. So what I want to do is kind of skip ahead because we're very short on time. I'm going to go to, I'm going to skip ahead from real estate. And I want to show you what I think might be an interesting place for your money as this bear market unfolds. And I think one of the places I want to focus on is cash, because there's a bull market in cash going on. Cash yields almost nothing right now. And people don't want to hold it. And the reason they don't want to hold it is because you're not getting a return on your money. But what we see in cash is a bunch of higher highs and a bunch of higher lows and a rising trend line. So if I would have to say, what should you focus in on right here with this bear market underway? My number one thing I would say is focus in on cash, because even though you're getting 3% or 4%, what you're doing really is outperforming other assets. What I've shown here is this is just simply the stock market S&P 500 that's inverted, and that's just the S&P right there. So your cash relative to stocks is going up in value as stocks go down. So I would consider cash as a key holding to be safe in this environment. Another thing you might want to look at is 2-year floating rate notes, which are adjustable. They'll never go below zero. They'll give you a great return relative to assets that are going down in value. So these are two things that I want people to maybe consider, take a look at, investigate. I think being safe in this environment is absolutely key. Don't get caught up in the remainder of this bear market, because as I showed with the cycles down and the bear market models pointing down, the initial wave into the end of this year, next year, or 2024 is going to be probably the sharpest bear market that we've seen since we've ever been involved in the markets. So anyways, if you're interested at all in learning about any of this stuff, please come to Elliott Wave International. Here's our website, www.elliottwave.com. We have a ton of free stuff on the website for you to check out, investigate what Elliott Waves are, how they work, how we apply them. And I think you'll find that we take a different view of how things work than a lot of the other people do. And it's interesting and it's fascinating, and we hope you enjoy it. So I thank you very much for giving me the time to speak with you this morning. And I look forward to speaking with you in the future. Thank you.
All right. Thank you, Mr. Hochberg. That was a fascinating presentation, and we really appreciate your time today.
Thanks.